organization, unless and otherwise the exports and domestic turnover percentage more is in the same range or it's at similar levels. One. And number two, as we also just now clarified, the estimate of cost could vary from one organization to another organization. To my knowledge, till 31st of March, nobody would have incurred any cost of significance. Okay, so everything that is getting reported is on a estimate basis. So only when you actually incur that cost, you will get to know the real cost, and this liability people will discharge over a period of time. So from our point of view, when Arnab had indicated in his speech in terms of this number, he indicated as a percentage of domestic sales. Okay, if you were to convert the expected liability, what would that be is based on that percentage. So you should at this point in time take more as an indicator, and the number percentage could marginally differ from one organization to another organization, while we don't have understanding how somebody else has done. I think it is on domestic sales. So on domestic sales, since it's not 100%, it is a certain percentage of our total sales, that is the way it would work out to. And it is also, please note, it is on production, not on sales. Okay, if there is any difference between production and sales, that will also have some implications. What you have produced, if you have not sold, okay, you may provide based on production, but it may not exactly match with as a percentage of sales.
Thank you for that explanation, sir. Just supplementing on EPR, would you need to use more recycled inputs as raw materials? Will this lead to increase in RM cost?
See, we already use some small percentage of recycled material, okay, and the product needs to be recycled, okay. It doesn't have to be incorporated in the tire manufacturer once again. Our endeavor is always, as a responsible corporate, our endeavor is to see how to use greener material, how to use a recycled material, so that it puts less load on the ecosystem. So from that point of view, if there's an opportunity for us to use more, we will certainly use, subject to our R&D and recipe permitting that. Okay, but however, our endeavor is to see how to create that ecosystem that will develop in terms of capability to recycle these tires. I think that is the direction in which industry as well as organization will work towards.
Got it, sir. Thank you so much. I'll fall back in the queue.
Okay.
Thank you. Next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Thanks, sir. Just wanted to understand, with this year, with strong margin and good business, working capital also supportive, good free cash flow generation, debt reduction. So what is the utilization segment-wise, and what is the planned capex for FY25, including maintenance, growth capex, everything? As such.
So plant utilization is around 80% in most cases, barring TBR, where utilization is very high. We have almost fully utilized the capacity, and we are expecting fresh production from our Chennai expansion project of TBR in Q2, scaling up in Q3 and Q4. So TBR is an exception. Otherwise, it's closing to 80% in all cases. Capex is around 1,000 crores, with about 250 crores of maintenance capex and about 750 crores of growth capex, primarily in Chennai TBR project, then our Ambernath expansion of agriculture radial project, and also in Chennai PCR project. These are the three main projects where the growth capex will be deployed.
Ladies and gentlemen, as there is no response from the participant, we'll move on to the next participant. The next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Hey, thank you, sir, for taking my question. This quarter, our volumes grew by 5%, and replacement segment also grew in that range. And you guided for a high single-digit, low double-digit growth in the coming quarters. So, what are the key drivers for volume trajectory to improve from here on? Can you just highlight some of those green shoots which you are seeing on ground? Thank you.
Yeah, so Q1 is a positive season for all kinds of tires because of the summer heat when tires are replaced, where it is also high. So we expect strong volumes in truck bus radials in replacement market, that is. We expect strong volumes in passenger radials, which is also aided by the election season. And the rural and small towns are showing signs of recovery. We have had very strong growth in replacement in motorcycle and scooter in the past 3-4 months, which we expect to continue in summers, with a gain in market share in passenger categories, both passenger categories. In the OEMs, the commercial category is muted because of elections and is expected to stay in that zone till about August, September, when we might see a recovery in truck tires OEMs. Two-wheeler is doing very well in the second half of last year and expected to do very well this year. They're still below the pre-COVID level, so we expect good headroom there. And passenger may moderate a little bit in the high base of last year in the OEMs, but still low single-digit growth is possible. April, they grew by about 1.5%. And globally, of course, in the international markets, we expect the launch in the US in the month of July or August, Q2, that is. Strong growth expected in Middle East, in Europe as well as Latin America. So that's the overall scenario of demand outlook across the three segments.
So, sir, any ballpark number which you like to share for full year in terms of overall volume guidance? It's just high single digit for full year across segments, like on a blended basis?
Yeah, we would be targeting about a double-digit kind of volume growth, high single-digit to double-digit kind of volume growth across segments. Yes, that's an average across segments, you can say.
Understood. Thank you so much. All the best.
Thank you.
Thank you. Next question is from the line of Amin Pirani from JP Morgan. Please go ahead.
Yes. Hi. Thanks for the opportunity. Just, going back to the EPR, and thanks for all the explanations till now. Just wanted to clarify, so I think there was a rule that, for a year, the provision which has to be made is for the prior year or, 2 years prior production, or is it like what provision you're making in FY24, that 70 crores, is for FY24 production and FY25 will be FY25 production?
See, the obligation for 22-23 is 35% of T-2. Okay, and obligation for 23-24 is 70% of T-2. So that is obligation.
Okay.
And if any unit company, tire manufacturer has come into existence during this interim period, then the obligation starts 2 years after that.
Okay. So for FY25, you will be providing 100% of FY23. Is that the correct way to think about it?
Yeah, the basis for that is T-2 production basis to arrive at that obligation.
Okay, understood. And just one, follow-up on this. You mentioned that, you will try to mitigate it through mix, price, and efficiency. So, given that this is going to impact all the tire companies, at least the domestic business of all the tire companies almost equally, are you not expecting that there should be a pass-through, at least on the OEM side, which is already on a formula basis? And even on the replacement side, because this is something which is an extra cost for everyone, or do you think that there could be, companies which would not pass it on, and hence there is some competitive activity on this basis also?
So on the OEMs, we have started engaging with the OEMs, and as you rightly said, it is an indexed formula for most of the OEMs.
Yeah.
So we are hopeful of the outcome, but it's basis a discussion with the OEMs and resolution on a one-to-one basis. Mm-hmm. In the replacement market, yes, it's a competitive situation. There could be competitive activity, but it is just like for the channel and the customers. It's just like any raw material input cost increase. So they are not really concerned whether it's EPR or it's some raw material cost increase. So the price hike will be just taken as if an input cost has gone up, and based on the competitive activity, of course.
Understood. Thanks for this. I'll come back in the queue.
Thank you. Next question is from the line of Mumkush Mandlesha from Anand Rathi. Please go ahead.
Thank you so much for the opportunity.
We're not able to hear you, sir.
Can you hear me now? Is it better?
Yeah, it's fine.
Yeah. Sir, I just want to understand on the market pricing environment in the market, sir. I mean, we have taken the price hike in the end of April. Particularly one large player is diverging in terms of price increases. So how do you see that kind of impact on the pricing for us, sir?
See, pricing, as I said, is not totally 100% dependent on competition as it used to be some 5-7 years back. There is some degree of pricing independence that is possible. There is some degree of market share movements also that are possible. But individual players decide on their relative strengths and take those calls. So it has played out over the last 7-8 quarters, and it will play out in future as well. So, and the quantum of price hike one may decide to take in different categories may also be different, right? So we have taken the price hike basis our strength and where we believe that we can pass it on without any significant impact on our market share or on our volumes. For example, in passenger car category, we took a minor price hike in Q4 and we gained market share in Q4. But it may not hold true for all categories for us and likewise for all the competitors.
Understood, sir. Just Kumar sir, what would be the impact of Red Sea on the freight cost for this quarter, sir?
No, see, freight rates have moved up for certain, so it has moved up for largely to movements to Europe. Okay, and the rate increase has been happening since beginning of Q4. So it's almost 300% increase is what has happened in freight rates. So it stays at that level now.
Okay, yeah, thank you so much.
Thank you. Next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Hi, my question pertains to the current quarter performance where if I adjust for the EPR provisioning, the EBITDA margins have improved almost 130 basis points vis-a-vis third quarter despite stable RM basket and likely impact of freight cost. So is this entirely due to mix improvement or there is something else which is not getting captured?
Okay, no, see, I think you are referring to the gross margin has improved by about close to about 100 basis points.
No, I'm referring to EBITDA margin. The EBITDA margins have improved about 130 basis points if I adjust for the EPR provisionings.
No, if you adjust for EPR provisioning, is that so? If you approximately, let's assume about 1.2% kind of an impact of Q4. So if you add it to the Q4 margin, it is not 1% improvement. It is about 20-30 basis points improvement over the previous quarter. That's what it is. So that's largely attributable to better mix. I think as Arnab had earlier mentioned, we grew strongly in replacement and exports, so that played some role. And the way gross margin, if you are referring to gross margin, the way it is computed is based on, it has some impact on account of if you hold a higher level of finished goods inventory, the way gross margin gets reported, it will tend to show a little higher because you adjust the closing value of finished goods, which will include non-material component, and therefore it might appear as a higher improvement in gross margin, but at EBITDA level it gets neutralized. So largely, I think if you add back, it is not a 1%. It is about 0.3% improvement over the previous quarter on quarter.
Okay, got it. And second question pertains, given that there is such a strong outlook for demand which we are looking at for FY25, and we are already at 80% ex of PBR. Do we need to increase our capex investments to meet this growth and also meet our market share aspirations, or we can manage through this bite-sized capex without looking at a large brownfield expansion?
As I mentioned, the CapEx utilization is highest for TBR. In TBR already there's a big expansion underway at Chennai, and we expect commercial production in Q2. So we are prepared for meeting the TBR demand and growing market share in TBR.
And for other segments?
Can you repeat, please?
For other segments, PCR and two-wheelers and APR?
For other segments, there is enough headroom to grow in the current capacity, and in PCR also there is an expansion going on, looking at future demand of 2 to 3 years. So the current capex outlay of 1,000 crores is sufficient to look after current demand as well as future demand in the medium term.
Okay, got it. Thanks a lot.
Thank you. Next question is from the line of Swechha Jain from Whitestone Financial Advisors. Please go ahead.
Hi, sir. So just coming back to the EPR provision. So what I want to understand is, going forward, every quarter, we will make a provision of 1.3 to 1.4% of the domestic sales. Have I got this correct, sir?
See, it is an indicator, I think, because it has just started in the quarter that went by, we had not incurred anything. So from our point of view, it's more an indicator. Okay, it could be in that range. It depends on the, cost of certificates. We will look forward to, we hope, government considers the request of the industry. So you use more as an indicator. I think we can keep fine-tuning in the coming quarters once we get a better hold on the certificates market. And also, we are assuming, as the need for recycling increases, there could be more players coming into the markets. So all these things will influence.
But we will be providing every quarter, or we will do like this?
Ma'am, we're not able to hear you clearly.
No, it will be on an accrual basis from here on. So I think the rationale for making the provision in Q4 we explained earlier. From here onwards, it's going to be part of our normal cost. Subject to, if we are able to get some benefit from through the interactions with the government, I think it will get adjusted appropriately. We look forward to it. But if it doesn't come, it will continue on a quarterly basis.
Okay. And just to follow up, if I can ask, actually, I missed the volume numbers that you were giving during the commentary. Could you just repeat those if possible?
The industry growth. Okay, so if you're talking of CEAT's growth numbers, volume, then we grew by about 6.5% on a full year basis, 5.3% on a quarterly basis. And this was distributed across the segments with very high growth in two-wheeler and passengers, and somewhat lower single-digit growth in overall truck bus. Specialty also grew close to double-digit. TBR grew in single-digit. So that's the kind of growth rate for Q4 YOY.
Okay, so this is replacement or OEM replacement growth, right?
It is overall.
Okay. So would you be able to give volume growth in replacement and OEM separately?
OEM, as I mentioned, we grew well in replacement, and OEM was moderate in Q4 overall. So most of this growth came from from replacement and international business markets.
Okay. Thank you, sir. Thank you.
Thank you. Next question is from the line of Nihar Dave from Living Root Capital. Please go ahead.
Hi, thank you for the opportunity for asking a question. But most of my other questions have been answered. I just wanted to ask, would it be possible to provide me market share breakdown by product or by segment category?
Are you asking for replacement?
For all of the segments, sir.
Approximately, as I mentioned in passenger, we are at about 70% in replacement. About two-wheeler would be about 35% plus. And truck bus radial will be still in single digit but approaching double digits. And this is replacement. In OEM it is similar. I mean the truck bus radial will be higher at about mid double digits, and passenger would be slightly lower than 70, and two-wheeler will be around the same, slightly lower.
Okay, got it. That's all. Thank you very much.
Thank you. Next question is from the line of Kaushik Poddar from KB Capital Market Private Limited. Please go ahead.
Hi, Arnav. This is Kaushik Poddar. I hope you can place me.
Yeah, Kaushik.
Yeah. Okay. I'm speaking to you after a long time. What is the stable margin you see? I mean, around 13-14% is the long-term margin we can take it as a long-term, whatever the target or something, or you can improve on it?
See, we don't give a guidance for future. We have been maintaining that we would like to maintain the EBITDA margin at in a tight, narrow band, because we invest when we can invest, as we are investing in the IPL in Q4, and Q1 also will be investing heavily in the IPL and brand. And when there's a raw material hike which we cannot mitigate, we manage the investment onto a next quarter. So basically, we are trying to manage in a tight band the EBITDA margin, and when that happens, usually it goes up over a period of time, provided there is no inflationary impact. So there are many things at play. If there's a sharp inflation, very difficult to manage the margin at current level. So what our endeavor is to manage it in a tight band.
Okay. And my next question, which is that, you said that as far as the passenger segment goes, PCR, you are able to at least set the price. I mean, which are the segments in which you are the price setters, and the segments you are the price takers? In others, which other segments you are the price takers?
There's no clear position that has evolved like that. In truck bus radial, where we are a single-digit market share player, we are price followers. That's for sure. Okay. In the other two segments, it depends on the situation and our need to gain market share. So sometimes we have been able to take independent calls on pricing in these two segments.
Okay. And as far as the market share goes, since you have such a high share in the two-wheeler segment, I mean, probably you are the highest. So don't you have a pricing power that much more there?
We do have pricing power relatively better in two-wheeler segment.
Okay. Thank you. Thanks a lot, Arnav.
Thank you.
Thank you. Next question is from the line of Ashin Modi from Equirus Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, my question was regarding EMP expenses. Could you quantify its impact during the quarter, and what sort of impact could we have in the next quarter because of this IPL and WPL?
It is 2 to 2.4% roughly. It varies, so it fluctuates around that. It will be more above 2 in these 2 quarters, and then maybe moderate in the subsequent quarter.
Okay. The last question is regarding this gross debt. We have reduced our debt significantly, so that's 460 odd crores this year. So how do we see debt reduction in the next year or next couple of years?
No, see, this year free cash flow generation has been very healthy. I think maybe highest. Going next year, I think it was indicated that our capex plan for next year is about 1,000 crores. Okay, and we would also like to normalize working capital. Okay, so because at the end of the day we have to meet the service levels across the geographies. So we managed to fund all our capex from internal accruals last year and still managed to bring our debt down. In the first half of the current year, we see some cash flow happening. In case of EPR, which we spoke about, there will be something. we've declared dividend just now. Okay, that itself translates to about 120 crores of dividend. So we will keep in mind, I think, we will keep the debt within a range. Okay, within a range. We are around 1,600 crores of debt on a standalone basis. We will keep within that range of about 200-300 crores on the higher end, and we'll continue to work in terms of opportunities to bring the debt down as and when it happens. But just want to share with you that we are comfortable at current levels of leverage. Okay, so I know we all know over leverage is bad, but under leverage is not good also. So from that point of view, we'll try to manage. And the reason for keeping the capex, it's more a preparation for the following year and year later on in terms of capacities, is also because of the fact that the balance sheet has strengthened. So we'll operate within this range.
Sure, thank you, sir. I'll get back into this.
Thank you. Next question is from the line of Amin Pirani from JP Morgan. Please go ahead.
Yes, hi. Thanks for the opportunity again. I just had a clarification. So what is the TBR capacity right now, and how much are we increasing it by in the expansion that we're doing in Chennai?
No, our factory existing capacity about 130,000 tires per month. It can be stretched a little bit. And what we are putting up in Chennai is about 45,000 tires per month. Progressively.
Okay. So approximately 30% expansion on the TBR capacity.
Yeah.
Okay. And this will be available for production in FY26, or this will start to become available during FY25 itself?
Our intention is to commission the plant in Q2 of the year. Okay. Normally, it follows through the normal ramp-up route. So Q3 onwards, it will start contributing to sales.
Oh, understood. Thanks for this.
Thank you. Next question is from the line of Raghunandan NL from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity. Sir, on the export outlook side, if you can give some more color in terms of how you see the sustenance of double-digit growth, which markets, which products are likely to do well, and how do you see that target of 25% share getting achieved?
Yeah, 25% is the saliency within CEAT, which is currently 19%. So as I have mentioned, the key focus is on agriculture radials, passenger radials, and truck bus radials. So strong focus on passenger radial and agriculture radial. Truck bus radial is coming up as maybe, we can say 2.5 categories. And the geographies are Europe, US, and Latin America. So these are the three geographies that we'll focus on. Out of which US, we have agriculture radial, which is scaling up. Passenger radial and truck bus radial are yet to be launched. In all other geographies, we have created the market access by way of distribution network. Product development is done. Product development is also done and tested for US. So this will be the focus market, and Middle East is also shaping up well, though I didn't mention about it earlier, but it may be the fourth area, but the first three are the focus area.
Got it, sir. And H2 of FY24 exports had grown in double digits, I think 15% plus. So how would you see, the double-digit growth getting sustained? Do you see any?
The international business is always fraught with higher risk because of various geopolitical events over which we don't have any control. If there are no major aberrations, then we see headroom for growth being a value brand, which is our products are very well accepted and at the right price at which we make good money. It is EBITDA accretive for us. We see a lot of headroom for growth in all these three geographies, barring some unforeseen risk which we have not accounted for. Those risks are always there.
Got it, sir. And Kumar, sir, can you quantify, you indicated 300% increase in freight cost on the Europe route. Like, would it be a 30, 40 basis